and welcome to this week's edition of Retire Well, the show designed to help you retire well in all aspects of your life. I'm your host, Kristen Oakley, and joining me in the studio is Kevin Bucher. He is the owner and a financial advisor at Citizen Advisory Group. We've got a great show for you today. The title of today's show is Get Off the Tracks, the Tax Train is Coming, and we're going to be providing lots of valuable information because at the end of the day, success in retirement, it's not about how much you have, it's about how much you get to keep, and we want you to not have to pay any more to the IRS than you are legally required to pay. Isn't that right, Kevin?
Yes, and you know, I think you've been around long enough, Kristen, you know that I actually enjoy talking about taxes. I enjoy being proactive in tax planning and trying to put together strategies so that we can keep more of our hard-earned money and give less to the IRS. So taxes are not a fun topic usually. To frame it as this tax train is coming, it's right here. Matter of fact, the tax train is coming, and we got to get off the tracks.
Yep.
That might sound scary, but it's time to be proactive and start to take the steps to de-tax our situation.
Yes, I like that. Instead of detox, we got to detax, right?
Yes.
Well, and I think everyone watching can agree that, you know, taxes, whether we like it or not, it's something that we have to navigate. And I think a lot of folks are unaware of this tax train that's coming. And I love that, you know, both you and I are very visual people. We love doing analogies on this show. We love having visualization. So talk us through the little setup you've got going on here.
Yeah, so hopefully this helps a little bit, right? So we have our tax train, and then the tax train is coming down the tracks here, and what is immediately in front of the train is your income. So every year our income is subject to taxation. And then as we work further down the road, we might have some money in tax deferred accounts. We might have some capital gains loaded up inside taxable accounts. Well, that's still sitting on the tracks. We've just pushed it down further. So we have some time before that tax train hits it. So we'll get into some more detail on that.
Yep.
But that's our setup here.
Yes, I like it.
Yes.
I'm here for it. Well, here's the deal that we need to help our folks understand as well. Two different things. One is that you all are not accountants, you're not CPAs at Citizen Advisory Group, but as you already shared, you do engage in strategic tax planning. Talk about what that is and why that is so different.
Yeah, and I'll start by saying a lot of firms, they're not willing to get into the tax conversation. And it comes from the top down, especially at the big box brand name firms, where they are not going to give tax advice. And we just feel like that is doing a total disservice. And we're going to get into this example a little later in the show, but I recently had a meeting with an individual that had some serious tax questions that they wanted to go through because they did want to start to be more proactive in their tax planning and take control over their tax liabilities. So I had a recent conversation where they were working with their advisor, and the advisor said, well, I don't know, what does your accountant think? You need to go talk to your accountant. And they went to see the accountant, and the accountant said, well, I don't know, what is your financial advisor? So it's just this rabbit wheel or hamster wheel effect of not really getting any help and support in this. And we step in and fill that void because we have the software, we have the experience, and we can really help to start navigate some of the tax liabilities that our clients are facing.
Yes, and to your point, this is so key, and this is what really sets you and the team apart, because I know a lot of financial advisors out there are not having these kinds of conversations with their clients. So, you know, stay with us because you're going to probably pick up a lot of information today that might be new to you, or that you just might not be having these kinds of conversations previously if people have worked with other financial advisors in the past. The second thing I want to, add is, why is this such a time-sensitive conversation for our viewers?
Yeah, so boy, that's a long question there, because there's a lot to talk about. So let me just start at the surface level. We're currently operating under the Tax Cuts and Jobs Act of 2017, which was not permanent law. And so we already know that after 2025, as we get into 2026, that Congress doesn't need to do anything. They don't need to pass any new laws, and we're going to be reverting back to the previous tax code. And for many Americans, that's going to mean an increase to your tax liability. So if you have a lower income situation, you might not be as impacted as others, because the 10% tax bracket is still staying the 10% tax bracket. Now, they are going to change the standard deduction, and a lot of us over the past several years have gotten to take a good advantage over a raised deduction amount. But at the lower income levels, it won't be as impactful. But as we move up the tax scale and we go into the 12% tax bracket, Well, that's going to 15%. It's going back to 15%. The 22% is going back to 25. So there's increases to almost all of the tax brackets that we know are coming that they don't even need to pass any new laws to enact.
And then on top of that, what else is going on?
Well, then you get to the scary part.
Right.
So you got the scary part of what's the future of taxation look like in our country. And I think if I asked 100 people, what do you feel about the future of tax rates, that they'll be higher or lower? And I'm pretty sure that 100 people would tell me that taxes are going to be higher in the future. Yet we continue to delay our taxation and kicking the can down the road. And sometimes that makes sense, but sometimes it doesn't.
Well, and part of it has to do with our national debt, which is over $35 trillion and counting. If you go to usdebtclock.org, make sure you're sitting down before you look at that site, because you're actually going to see the national debt going up in real time. This is why most people believe taxes are definitely going to have to go up.
Yeah, so when you look at that website, it's a website that I do frequent, and you know, the national debt is closing in on 35 trillion. And then when you look at the 4 biggest budget items on the government balance sheet of Medicare, Social Security, the defense, and now the interest on that debt, that is more than the tax revenue that we're bringing in just in those 4 budget items. So we're going to continue to operate in deficit spending, adding on to that national debt. So the reality is one of 2 things has to happen, right? Government spending has to come down, which there hasn't been a whole lot of direction in that. We haven't been moving in that direction. Or we're going to have to raise revenues, and the only way that the government can raise revenues is to increase the tax rates. So it's very likely that we see increases in tax rates. And all of this conversation makes me think of a cartoon that I know you're familiar with because we've talked about it before. It's the Roadrunner and Wile E. Coyote story.
Oh, yes, classic. It doesn't get better than that, right?
Yes. And I think all of the episodes are kind of the same principle or theme, but there was one in particular episode where Wile E. Coyote was busy working in his shed to build the bomb to get the Roadrunner. And what he didn't realize, because he was so busy building this bomb, that the Roadrunner came and pushed his shed out onto the railroad tracks. So the train was coming down the tracks, and the Roadrunner had pushed that shed out onto the tracks. And the train had a whistle, so Wile E. Coyote heard the whistle, and he looked out the window. And when he saw the train coming, the right thing would have been to get off the tracks, which is what we're going to talk about today on how to get off of these tracks. But what Wile E. Coyote chose to do instead was to pull the shade down on the window. And
his ears went down simultaneously. I can picture it, right? Like, oh no, I'm doomed.
You
basically
know the episode.
Yep.
So he pulled the shade down and ignored that this problem was coming. And of course, the train hit his shed, and he came out of it much worse for wear. It never killed Wile E. Coyote, but he came out of it much worse for wear. And it's the same story that we're doing on set here today, that you have your hard-earned income, you have your hard-earned assets setting on the railroad tracks with this tax train barreling down on you. So we have to start to take the steps to get your assets and income off the tracks so that the tax train doesn't take too much of your hard-earned money.
And this is why this is a huge piece of a written financial plan, is engaging in that strategic tax planning. And I know this is what we love to offer to our television viewers, is the complimentary written financial plan. Talk a little bit about the tax piece of that plan and what they're going to be able to walk away with as a result of meeting with you and the team.
Yeah, so the taxes are a big part of what we look to do. So we really have to build out some retirement income projections for you so that we can do some comparisons of your income across time. So it's important that when you think about the taxes, that we're not just thinking about, okay, tax rates will be higher in the future, because your income also plays into that. So we need to be able to do projections across time so that we can see what your income levels will be before we start to do the tax planning. Once we know that, it's just a mathematical equation to determine, well, what is going to be full price of the taxes, and we're then looking for what are the sale prices that we can start to pay the taxes at. And sometimes that means, and we'll talk about this in the next segment, sometimes that means taking money out of this tax deferred bucket and shifting it over into the income bucket this year, because that's at a lower rate than what we're going to have in the future.
And no doubt there's so many strategies, so much planning that goes into this. So Kevin, thank you. I'm excited to continue this conversation with you. But if you're sitting at home and you're going, you know what? I know that my accounts are sitting on the track, so to speak, and I know that the tax train is coming, and you want help figuring out how to navigate, how to create greater tax efficiency throughout your full financial plan, we invite you to pick up the phone and call 866-630-1675 to claim your very own complimentary written financial plan from Kevin and the team of Citizen Advisory Group. Or if you'd rather connect online, we've got you covered. Simply pull out your smartphone, and if you open up that camera app, you can point, click, and scan the QR code that you see there down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team from Citizen Advisory Group will reach out to connect with you to schedule your complimentary written financial plan that way as well. We'll be back with more on this important conversation of getting off the tracks, because the tax train is coming, right after this.
I think we recognize as a firm that thought of meeting with a financial advisor and discussing your personal finances causes some anxiety.
It can be kind of overwhelming or intimidating for some.
It's similar to the emotions I have about the dentist. I recognize that going to the dentist is really important, and I want better dental health. I don't look forward to going to the dentist. But what I have found is it ends up not being as bad as what I thought. I think that relates really well to those emotions that people have about meeting with a financial advisor, that it might cause some anxiety, but it wasn't nearly as bad as you thought. And when it's all said and done, you feel so much more comfortable about the steps you took and the financial security that you're building for yourself.
We have a beautiful home office in Perrysburg that we built with intentionality. We want to try to take down those walls to make it home. When you come into our living room, the fireplace and couches, and when people come in, we want to have that comfort level of family and trust and open communication, just all the things that are important to be successful.
Imagine not having to face your retirement with the same old corporate solutions as everyone else. In these economic times, you deserve a fresh perspective that includes a personalized retirement income plan, investment portfolio analysis, and tax map from an independent fiduciary advisor whose focus is on you. Call the number you see here to schedule your complimentary review right now.
Welcome back to Retire Well. I'm your host, Kristen Oakley, here with Kevin Bucher, owner and financial advisor at Citizen Advisory Group, and we are having a great conversation today all about engaging in strategic tax planning, because like it or not, the tax train is coming. And Kevin, I love this analogy and this setup that you have here. We've been talking about how it's time to get off the tracks because this tax train is coming. I would love for you to share with our viewers a little bit more about these different buckets that are currently sitting on the tracks and what folks need to understand about them.
Yes, so here we go. So the one that's immediately in front of the train is your income. Mm-hmm. So every year we have to file a tax return, and our income is subject to tax. So what is income? Well, income is going to be your wages. So if you're still working, it's your wage. Mm-hmm. If you're retired, it might be your pension. That's going into this bucket. If you're retired and you're drawing your Social Security, well, that one's interesting, because does Social Security go in the bucket? That's a question I like to ask people. Mm-hmm. Is your Social Security taxed? And the answer is not yes or no. Well, it depends. Yep. And it's different for everybody. So some people don't pay tax on any of their Social Security. Some people are paying tax on up to 85% of their Social Security. Mm-hmm. So not all of your Social Security is going to go in your income bucket. Right. So I kind of would relate that to like cooking. Mm-hmm. So following a recipe. So the Social Security formula is going to say, okay, well, how much of an IRA withdrawal do you have? How much of a pension do you have? And it's putting this recipe together, mm-hmm. and then that recipe determines how much of your Social Security goes into this income bucket each year. Mm-hmm. So you want to get that recipe right, because you want to keep more of your Social Security out of the bucket, right, and less in the bucket. Mm-hmm. So you have your dividends and interest from a taxable account that are taxable, that are going in this bucket every year. So every year, money's going in your income bucket, mm-hmm. and that's going to be subject to the tax train that's right in front of it. That's the first thing the train hits, so to speak, right? Yes. Now, there's things you can maybe do mm-hmm. to take some money out of that bucket. So if you're still working, for example, we can take money from our income mm-hmm. and shift it over here into the tax deferred account, like a 401k contribution or an IRA contribution.
Right.
We also get to take money out of that bucket for the standard deduction, or if you're itemizing your deduction. So not all of your income is subject to the tax strain. But you have to ask yourself, if you choose to take money out of this income bucket and put it down here into the tax deferred bucket, that's not off the tracks yet. So that is still setting on the tracks.
Right.
You just are pushing it down the road, and you're going to deal with the taxes on that later. So I like to look at that as, well, when you put money into your IRA or 401k, you're really just doing an IOU to the IRS. Now, it doesn't mean it doesn't make sense to do that.
Right.
Because it's going to come back to, well, what is going to be your individual tax rate when you decide to take money out of that tax deferred account? So you want to make sure you're doing individualized tax planning. So even though we believe that tax rates will be higher in the future, that doesn't necessarily mean that your individual tax rate will be higher in the future. So you have to do some projections to determine if that's true or not. But so from an income standpoint, that is what's right in front of the train each and every year. There are a few levers you can pull to adjust the income that's going to be subject to tax, but that's the income bucket.
Right. All right, so the income bucket, then we've got the tax deferred bucket, which we already said earlier is where the majority of Americans have the bulk of their wealth saved up. Maybe it's a 401k, a 403b, traditional IRA. This is why it's almost like folks are sitting on a ticking tax time bomb, right?
Yes. So that would be another way to frame this show, is how to diffuse the tax bomb.
Yes.
So, so you know, we've got money setting in these tax deferred accounts, and that is where the bulk of the retirement savings is lying today. But I think it's worth pointing out that you don't see the third bucket for where you can put money. So you can put money in a tax deferred account, you can put money in a taxable account, you can also put money in a tax-free account. I didn't make a bucket for the tax-free account because it doesn't go on the tracks.
Right.
Because it's tax-free.
Yeah, exactly,
right?
Yeah.
So as you're thinking about your tax deferred account, that could be your IRA contributions, your 401k contributions, and you have to, again, do these projections across time of what's my income today and my tax liability or tax rate today versus my tax rate when it's time to take money out of this bucket. Because you cannot escape paying the tax out of these buckets.
Right.
But what's going to be your individual rate when it's time to take the money out of the tax deferred? So as you're putting money into these accounts, you have to be able to do that analysis to determine how much do you put in. Because what you don't want to do is have too much money setting in this tax deferred account. Because at the age of 73, and for some of our listeners 75, because they keep changing and raising the age of this, you will be required to take money out of this bucket and move it into that year's income. So we need to know what that's going to look like, because we don't want to put so much money into this bucket that when we have to pull money out, it adds too much money into our income, pushing us up into higher rates.
Exactly right.
So we can only kick the can down the road so far before the train is going to hit us. And if we wait till this tax train is going to hit us with a higher and higher rate, it doesn't make sense.
Right.
So we got to start pulling the money out of this at the strategic way at the lowest rates possible.
And that's what we want to spend the rest of the show talking about, right? Are the solutions and the strategies behind how you diffuse that ticking tax time bomb, if you will.
Yes. Yes. And then my final bucket here is your taxable accounts. So this would be your bank account, for example. So I think we're all probably aware that when we invest money in a bank account that pays us interest, we get a statement at the end of the year that says we made $1.75 of interest, and maybe that'll change now that interest rates are a little better, but we make a little bit of interest, and that still goes into the income for that year because this is a taxable account, so your interest earnings every year are taxable. So we want to kind of control what we put into this bucket because it shows up on the income tax return each and every year. At the same time, it doesn't have to be a bank account. I could open up a taxable brokerage account and invest in stocks and bonds and mutual funds. But now, as that account grows and appreciates, I will be subject to capital gains, right? So two forms of capital gains. I know that taxes are fun and super simple, but we can make them simple, but there's unrealized gains and then there's realized gains. So I don't have to pay the tax on my gains that are unrealized. So what I mean by that is if I buy a stock and I hold it and it's gone up in price, I haven't realized the gain yet because I haven't sold the stock. So that's still, the tax liability is still setting in that bucket, but it's way down the tracks. But as soon as I realize that gain, it now moves over here right in front of the train because it is going to be taxed in that year.
So at ordinary income rates?
Well, it's going to be taxed at capital gains rates,
right?
Well, that's a trick question too, because it depends on how long you've held the investment.
Exactly right.
So if you've held it for a short term, it's taxed at the income rates. If you hold it for long term, it's taxed at a more favorable capital gains rate.
Right.
But you get to control when you realize your gains. And again, strategically, we see people miss these opportunities on a regular basis to realize gains at very low or no tax liability, and just leaving that gain setting in this bucket for later and paying at a higher rate in the future. So we have to have strategies on looking at those capital gains on an annual basis as well. Right. And that's kind of the game of taxes, that we want to strategically manage the tax liability. It's part of the written financial plan process. So if you're concerned about what your individual tax liability is now and in the future, now is the time to take action and sit down with one of our team members and start to build this written financial plan.
Wonderful. Kevin, thank you so much. When we come back, we're going to be talking about some solutions of how to do that, but it starts for you individually and personally by picking up the phone and calling the number you see on the bottom of your screen to claim your complimentary written financial plan. 866-630-1675 is the number to call, or again, you're also welcome to scan that QR code and that will get you connected as well. We'll be back with the solutions for how you can get off these ticking tax time bombs, if you will, how you can get off the tracks right after this.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Kevin Bucher of Citizen Advisory Group. If you have amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. This is one of the greatest tax windows in history. Now is the time to take advantage of this tax discount while you can. We specialize in retirement planning, tax mitigation, legacy planning, and so much more. Plan your retirement right. Call now for your own complimentary portfolio review and written financial plan.
Whether it's time with your grandkids, travel, or finally doing what you've always wanted, retirement is about having the time to live life on your schedule. At Citizen Advisory Group, we build comprehensive retirement plans customized to your individual goals. Whether you're still preparing, taking your first steps, or have been on the path for years, our trusted and caring professionals are here to help you manage the risks and navigate the challenges on the road to your financial future. Citizen Advisory Group, your retirement journey begins here.
Welcome back to Retire Well, where today we are talking all about the tax train that's coming and how you can be prepared so that you are not unintentionally sitting on a ticking tax time bomb. We're calling this get off the tracks, right, Kevin?
Yes.
And there's so many strategies that you're able to employ for people on the front end when you are engaging in that proactive tax planning process to make sure that these things get diffused. So I'm excited for you to share what some of those solutions are.
Well, and I wish we had more time. And I think that's true for this episode, that if we had more time, we could build out these topics. But as I'm sitting here, that's true for many people when it comes to this whole concept of tax, that we need time to spread out the tax liability.
Yep.
So the sooner you start to take action, the better, because too often what happens is we continue to procrastinate on the tax planning, and then the windows close on us, and we have to take more money out than we would have necessarily if we planned ahead of time, which automatically pushes us into a higher tax bracket. So we need more time on this show, but we need more time with our clients over many years to spread out the tax liability. So the time to act is now.
Yes, for sure.
I want to jump into the client that I mentioned earlier that, they went to their financial advisor who referred them back to the CPA, and the CPA referred them back to the financial advisor, and they really weren't getting their questions answered. And their situation was this. They had been good savers, and so they had built a nice nest egg that was 100% sitting in the tax-deferred accounts of 401ks and IRAs. And so they were currently utilizing those accounts, but only a little bit, to supplement their Social Security and pension income that they were paying tax on every year. So their tax bill at this point was not terrible for them. They were in a manageable tax bracket, but as we mentioned earlier, we know tax rates are going up in 2 years. So they wanted to take advantage of today's lower tax rates. That was part one of the story. But they were equally concerned about what was coming when they got to the age of 73. Because again, at 73, you are now required to take money from the tax deferred accounts. And even though they're already drawing from the tax deferred account, their age 73 requirement was much more than what they were currently taking to support their lifestyle. And when they took that higher amount, it now pushed them up into a new tax bracket that they were trying to avoid.
Right.
Now, they were 65 years old. We have 8 years to work with on how to start taking money from the tax deferred account and getting it into the income now before we get into that higher tax bracket.
And before they hit that required minimum distribution age.
8 years before they get to 73. So that tells me that we have 8 years to work with. We can divide what we need to do over the next 8 years so that we can bring their distribution requirement. Again, the required minimum distribution at 73 is a mathematical formula that says if I have X amount of dollars, divide that by your life expectancy, you have to pull Y out every year. So we can work with those numbers to say we got to bring that distribution down so that it keeps you out of that higher tax bracket with your income each and every year.
Right.
So it gave us exactly what the target was on what we needed to Roth convert. So Roth conversion is the process of taking money from your tax deferred account, putting it into a tax-free account, and getting it off the tracks. So in their situation, again, we were able to do the math, and we didn't need to convert all of their tax deferred money. We just needed to convert the top part to reduce their distribution and keep them under that higher tax bracket. So for them, it told us exactly how much we needed to convert over the 8 years. Again, they were bounced back and forth between their financial advisor and their CPA. So if you're looking for these same type of solutions on how you can get your hard-earned money off of the tracks, our team is standing by and ready to start to do the math to build you a written financial plan to de-tax your retirement situation.
Wonderful. Kevin, thank you so much. And thank you to the entire team of Citizen Advisory Group and your passion and your care of helping folks mitigate their tax liability. The reality is if you're already working with another financial advisor and they're not having these kinds of conversations with you, it's time to get a second opinion. 866-630-1675 is the number to call to get your complimentary written financial plan. We look forward to being back with you next time here on Retire Well.